All right, welcome to Talk Tickers. Today, we're jumping right into Orrstown Financial. They just dropped their third quarter earnings, and let me tell you, it sent a pretty loud and clear signal to the market.
And just how loud was that signal? Well, check this out. The market didn't waste any time. The stock shot up more than 4% on some really heavy volume right after the release. So the big question is, what exactly did investors like so much in this report? Well, it really started from the very top. The CEO, Tom Quinn, came out swinging, calling it their strongest quarter of earnings on record. Now, you and I both know, talk is cheap, right? So let's see if the numbers actually backed up that kind of confidence. And wow, they absolutely did. Just look at these headline numbers. It was a solid beat on both the top and the bottom line. Earnings per share hit $1.13, which, just blew past the consensus of $1.06. And revenue, same story, came in higher than expected. This is exactly the kind of clean, no-nonsense beat that really gets Wall Street's attention. Okay, so let's dig a little deeper. Let's get inside the numbers and figure out what was really firing on all cylinders to drive this kind of beat. It's really a story about getting lean and mean after their latest merger. So one of the first places you got to look for a bank is its efficiency ratio. Basically, how much does it cost them to make a buck? And look at this drop, a huge improvement down to 56.4%. This is the big one, folks. It tells us that all those promised cost savings from the merger, they're not just talk anymore. They are hitting the bottom line, for real. But listen, this was not just about cutting costs. Not at all. The core engine of the bank was humming. You're seeing a return on assets of 1.6% and a return on equity of almost 16%. I mean, those are fantastic numbers. It shows they're just really, really good at making money with what they've got. You add in some solid loan growth on top of that, and what you've got is a picture of a bank that is just being managed incredibly well.
Okay, now let's talk about the net interest margin, the NIM. This is the bread and butter for a bank, right? Their lending profitability. And it was a super strong 4.11%. And there's always a but, isn't there? There's a little catch here. A good chunk of that number came from a temporary boost, an accounting thing from the merger. That boost is going to fade. So the billion-dollar question for investors is, can the real underlying margin hold up on its own? Management is basically saying, you bet it can.
So that leads us right to the next big question. How are they going to keep this train rolling? Let's take a look at what management is planning for the future, especially with the economy being, a little tricky these days. The CFO, Neelesh Kalani, he really laid it out there. Their whole philosophy is to lead with risk. But the most important part, he's telling the market they can keep that net interest margin right around where it is, even if the Fed starts cutting rates. I gotta tell you, in this environment, making a promise like that, that's a bold, confident move. And it wasn't just talk. He backed it up with a really clear 4-step game plan. Step 1, protect that margin at all costs. Step 2, keep growing loans, but do it smartly. Step 3, go out and actively find cheaper deposits. And step 4, keep that fee income nice and stable. See? No fluff. It's just a simple, clear strategy that they can actually go out and do. All right, but as we all know, no company, especially a bank, lives in a bubble. So the Q&A with the analysts, that's where we really got a feel for the battlefield out there, what Orrstown is really up against. So what was the big takeaway from all the questions? Bottom line, it is tough out there. Management kept saying they're seeing heavy competition on what they can charge for loans and what they have to pay for deposits. But, and this is key, they kept coming back to their discipline. They're not chasing bad deals. Their credit quality is holding up. And they even made a really smart move to pay down some expensive debt to save money down the road. Proactive stuff. And this right here is one of their secret weapons against all that competition. That slice of the pie is their fee income. It makes up a really solid 21% of their revenue. Why does that matter? Well, that income isn't tied to the crazy swings in interest rates. It's like a built-in shock absorber. When lending gets tough and those margins get squeezed, this part of the business helps keep things steady. Okay, so let's pull all these threads together. We've got the hard numbers, we've got management's game plan, and we've got the lay of the land competitively. Now it's time to put it all together and figure out what's next for the stock. And that brings us to the most important question, right? What's the play here? So let's lay out the argument for the bulls and the bears as we look towards the next few months. So the bull case, it's pretty simple, really. It's all about execution. This team is just firing on all cylinders. The merger savings are real, you can trust their guidance, and that fee income gives them a great safety net. Now, the bear case? It's not really about the company, it's about the world around them. It's about all that macro pressure. The big question is, can they really hold the line on margins if the competition gets even uglier and rates keep falling, especially once that little accounting helper goes away? So, if you take what they told us at face value, here's what we're modeling for the next quarter. We see things cooling off just a tiny bit, totally normal, but still staying very, very strong. We're penciling in earnings around $1.10, with that all-important NIM landing right in the middle of their target range, and fee income staying solid. So when you put it all together, our call here at Talk Tickers on Orrstown Financial is a solid outperform. And here's why. It's pretty straightforward. This wasn't just a beat for the sake of a beat. This was a high-quality beat. It was driven by real improvements in how they run the business. That efficiency ratio dropping like a rock is all the proof you need that their merger plan is working beautifully. And look, the market loves a simple story. A team that says what they're going to do and then goes out and does it. That's what we have here. Plus, with a strong capital position, they've got plenty of options.
This is not financial advice.